So good evening once again. Good evening to our speaker of the evening, Professor Dr. Ram Mohan. We'll start the proceedings with the silent prayer. Can I ask all of you to be seated and close your eyes and pray to Almighty? Thank you so much. Good evening once again, Professor Dr. T.T. Ram Mohan, all our invited guests, Program Committee Chair Mr. S.R. Nair, Vice President Mr. Balakrishnan, other members of the Managing Committee, members of KMA, Honorary Secretary Jomon, members of other LMAs, students and invited guests. Good to see that we have a fairly good attendance today in spite of the rains. In fact, myself and Past President Essa were discussing whether to speak to the speaker and ask him for an excuse because of these rains. I mean, still feeling a bit worried because I'm keeping my fingers crossed. The power is not there. Net is holding stable now. Let's hope that it'll stay on. Well, this event has been organized so soon after the big event early this week. But the topic and the speaker are both so compelling that we did not want to keep it off to the next month, as the session which is going to cover a topic is very timely and a relevant one, and many of us were concerned about this matter to be discussed and deliberated here at KMA at the earliest. This has been our way of keeping our members engaged and providing with these kind of meaningful deliberations and organizing topical events. Since we started our activities this year, Professor, we had 9 such LeaderTalks sessions till now with celebrated leaders from the industry and the academia. And this is the 10th one, which is yours. We also had the Chief Secretary of Kerala coming in for an inaugural session and also had the Chairman of LIC, Mr. M.R. Kumar, addressing us during the same inaugural session. Our KMA Women Managers Forum has organized 4 events till now, and the next one from them is slated on 8th April. They take the second Thursday of every month. Another feature of this year has been the StartCon sessions, an exclusively conceived panel discussion by our Program Committee Chair, Past President S.R. Nair, showcasing successful startup entrepreneurs to the KMA fold. We've had 4 such sessions till now, featuring some of the smartest brains of Kerala who have broken into the big league. These sessions have really come out as a great platform for these young entrepreneurs to showcase their success stories and also giving them an opportunity to reach out to the stalwarts at KMA for getting the invaluable guidance and mentoring on their ways forward. In addition to all this, there were 3 panel discussions with our own in-house experts and some of the industry stalwarts on topics of contemporary relevance. Last month, we've had a week-long intellectual feast in the form of the KMA Management Week celebrations, the KMA Virtual Run, the annual Students' Convention, and the Professor M.V. Piley Memorial Lecture, along with the Management Week celebrations, saw unprecedented participation by our members. This event actually saw many distinguished speakers addressing us, starting with the IMA President, Mr. Harshpati Singhania, the Director General at IMA, Ms. Rekha Sethi, Professor Ranjan Banerjee of SP Jain Institute, Mumbai, Mr. D. Shivakumar of the Aditya Birla Group, Dr. Saji Govinath, the new Vice Chancellor of Kerala Digital University, Mr. Ajay Prasad of Taurus Investment Holdings, leaders from multiple domains explaining the trends ahead for our student members, and also 3 of the startup heroes of our state sharing their success stories. And this week, as I've mentioned earlier, on Monday, 22nd March, we've had the 5th KMA Annual Digital Summit, chaired by our Vice President, Mr. A. Balakrishnan, as the Secretary told you rightly. We had Mr. Muhammad Safirullah, IAS, the Secretary to the Department of Electronics and IT of Government of Kerala, as a chief guest, and distinguished speakers like Mr. Mitesh Agarwal, the CTO of Google India, Mr. Ajit Menon, CSO of TCS, Dr. Saji Govinath, again our own MC member and the Vice Chancellor of the Kerala University of Digital Science, Innovation and Technology, Mr. Tapan Rai Guru, CEO of Kerala Startup Mission, Dr. Kunjaria P. Isaac, Director General of the Zaim Group, Ms. Anuradha Shenoy of BPCL Kochi Refinery, and Mr. Rajiv Prakash, CEO of Deshpande Startups, addressing us on various facets of the current digital transformation that is sweeping us, our businesses and professions. The theme of the summit itself was coined as New Paradigms Progressing Digitally. In addition to all these events, Professor, we have also seen a new revamped recreated KMA magazine, the KMA News, released by our editorial team headed by Mr. Balakrishnan for the last 4 months consecutively. The February issue covering the Management Week celebrations and a host of other features is in transit, and members will be receiving the print versions anytime soon. We've also revamped the website of KMA and put together a new mobile app exclusively for KMA members during these pandemic times. KMA also has recently been formally recommended for the award of the globally recognized ISO certificate for quality management system as per ISO 9001-2015. So these are some of the ways in which KMA tries to keep our members updated and in sync with the developments around the world and in our country in particular, while all of us are grappling to have a firm footing in these challenging times. Today, we have yet another very topical session underway when we have one of the most sought after speakers and a master on the topic to be covered with his multifaceted professional experience and in-depth domain knowledge. It is only recently that the bank employees across the country had gone into a 2-day strike against Sender's announcement of privatization of the banks. In 50 years, the banking industry had come to a full circle. Nationalization in 1969 and now to privatization in 2021. There are many questions everyone is asking these days on bank privatization, on the rationale of privatizing the banks and how it helps Indian banks sustain global competitiveness through privatizing. And more importantly, from an individual's perspective, what protection does it offer to the bank employees and what customer advantages does it offer? Well, we have got the most respected authority on this subject, Professor Dr. T.T. Ramohan of IIM Ahmedabad, to give us the much needed clarity on this subject. And we all look forward to his lecture on this. On behalf of the Managing Committee and all of us present here, may I extend a hearty welcome to you, sir, Professor Dr. T.T. Ramohan, to this LeaderTalks lecture session. Welcome to all the past presidents present here, members of the Managing Committee and Executive Committee, members of KMA and LMAs, student members, members of the media, and all invited guests to this lecture session, which is about to begin. So without further ado, let me invite our Program Committee Chair and past President, Mr. S.R. Nair, to formally introduce the session, the speaker, and also take us through the session, including the Q&A after the talk. Over to you, SR. Thank you.
Please unmute me. Hello.
Prajit, can you unmute SR? It's done.
Yeah. President and Chair of the session, Madhav. Host, I was so worried that actually we have hit 100 now, Madhav. Okay, I was really worried with this storm on, how many people will be late lessons. Great feeling. Balasan, welcome. Yeah. Let me please introduce Professor TTR, as he is commonly called, otherwise Professor Dr. T.T. Ramohan. Professor Dr. T.T. Ramohan, Professor of Finance and Economics at IIM Ahmedabad, graduated from IIT Bombay and IIM Calcutta and obtained his doctorate from Stone School of Business, New York University. He has been at various points in time a management consultant, a banker, an investment banker, and a financial journalist. His research interests include banking reforms, privatization, and corporate governance. He has published numerous papers and has contributed extensively to leading publications such as the Economic Times, Business Standard, The Hindu, The Wire, Bloomberg, host of them. Professor T.T. Ramohan had served on the board of several companies and premier institutions and have been a member of committee of RBI and SEBI. He is a respected author and his book include Privatization in India, Challenging Economic Orthodoxy, Brick by Red Brick, Ravi Mathai and the Making of IIM Ahmedabad, Rethink, What's Broke at Today's Corporations and How to Fix It, and Towards a Safer World of Banking, Bank Regulation and Other Subprime Crisis. He is now stationed at Ahmedabad. Let us hear from him. Professor, you have about 40 minutes to speak, after which I will engage you with some questions and I'll also take questions from the audience. The audience, you will continue to be muted, but you may please send your questions to the chat mode. Professor, all yours. Please go ahead, sir.
Professor, you got to unmute. You got to unmute yourself.
Please unmute, sir.
Yeah, that's done.
Can you hear me now?
Yes. Yes.
Well, thank you, Mr. Nair, for your introduction, and thank you, Mr. Madhavchandran, for your very kind words and also for your invitation. I must also thank my old friend of many years standing, Joseph, for having suggested this idea of a talk in the first place. It was very interesting to hear from Mr. Madhavchandran about the numerous activities of Kerala Management Association. And I have to say that this seems to be a very vibrant association with a very impressive range of activities. I think everybody understands that Kerala needs more management, more entrepreneurship, and associations like Kerala Management Association have a very important role to play in facilitating greater entrepreneurship and better management in Kerala. So I'm very happy to hear about your activities, and I wish you the very best in the years to come. Perhaps before I commence my talk, I should mention that my family has very deep and long links with Kerala. My grandfather spent most of his working life in Alvai. He was head of the Department of English at Union Christian College, Alvai.
Oh, wow.
My mother and her siblings grew up in Alvai. And there are two things that they learned during their long stay in Kerala. One was, of course, Malayalam. My mother is very fluent in Malayalam. And the other is that they are all very good at swimming, having learned the lessons the hard way, swimming in the Alvai River, Periyar River. And so I've heard a great deal about their days in Alvai. And some years ago, when I had a chance to visit the resort at Kumarakom, I made it a point to stop by at Alvai and go to Union Christian College, where I had the good fortune of seeing my grandfather's portrait there. He was among the very few people honored for his singular contribution to that college. I also had a chance to visit the beautiful resort at Munnar, and of course had links with IM Kozhikode and the Center for Development Studies. So I have to say that I have the greatest respect and affection for the state of Kerala and the people of Kerala. Beautiful state and truly vibrant people. I'm very grateful for this opportunity given to me by Kerala Management Association to have this interaction with a segment of the people of Kerala. Thank you very much once again. So let me just attach my presentation for today.
Yeah.
So can you see that?
Yes, it is. Yes, go ahead, sir. Yeah.
Yeah. So the topic, as the President mentioned for today, is issues in bank privatization. And as Mr. Madhavchandran correctly mentioned, this is a topic that is agitating large numbers of people, not least the employees of public sector banks. And I think there are several questions that will come to the minds of people about the rationale for bank privatization and what course it will take. So the way I've structured my talk is to think of the issue in terms of three questions. First is why privatize? The second is, having taken the decision to privatize, how, what, and when to privatize. These are operational issues. And having dealt with the first two questions, I will proceed to frame some tentative conclusions. And of course, I would very much like your feedback on the subject. So let me begin by taking up the first question, why privatize? And I think there's been a very clear policy shift, as Mr. Madhavchandran mentioned. As he said, after 50 years, we have come from nationalization of private sector banks to the privatization of nationalized banks or public sector banks. And I think as you're aware, a formal decision has been taken to privatize two public sector banks in the coming financial year 21-22. And this, of course, this marks a huge policy shift. And I think it's part of a larger attempt to push privatization in a very big way bank privatization is part of the larger scheme of privatization, in which a large number of public sector undertakings will be privatized, and the PSUs are to be confined only in designated strategic sectors. And even in those sectors, not more than a certain number will be left. I think they're talking about 4, but it could be fewer than that. And the interesting thing, as many other commentators have also pointed out, is that no clear rationale has been articulated other than to say that government should not be in business. But that, of course, begs the question why government should not be in business. I mean, it's very hard to accept on theoretical principles that there's something evil about government in business. So that part of the argument is not being made at all. But I think one thing that is very clear is that fiscal considerations are certainly a driving factor. So the government is short of revenues. We are staring at huge fiscal deficit in the financial year 2021 and with substantial deficits in the years to come. And the government no doubt sees privatization as a way of augmenting revenues and making up for shortfalls on account of tax revenues and other sources. So that's clearly an important reason, but that's not how it has been presented. So in the discourse which has happened on privatization, 2 reasons have been cited by commentators. The first commonly cited rationale is that private sector banks are more efficient. So by privatizing public sector banks, you're creating greater efficiency in the economy. This is one argument. And the second argument is that the inefficiency of banks makes demands on capital from the government. So if the public sector banks keep running up losses, as they've been doing in recent years, then the government has to put in more and more capital, on which they say government doesn't get adequate returns. So essentially, a large public sector presence in banking is tantamount to, quote, money down the drain. So these are the 2 arguments that are being made, the efficiency argument and the fiscal argument. So let's go and sort of dissect these arguments in some detail. So when you're saying that private sector banks are more efficient than public sector banks, as an academic, we would break this down into several parts. The first is that we would look at the comparison of performance based on particular performance indicators. And typically, when people say that the private sector banks are more efficient, they look at a difference in performance at a given point in time. So they will cite, say, last year or the previous year, which are all bad years for the banking system. And based on the differences in performance at a given point in time, they will say, look, the private sector is more efficient. But as academics, we would compare performance over a longer period, and we would also see whether the differences in performance are statistically significant. Now, if you look at 2 numbers, let's say return on assets, a private sector bank is 1.3, and let's say public sector is 0.9, 1.3 is clearly higher than 0.9. And the layman will say, well, private sector banks are more efficient. But academics will ask the question, is 1.3 statistically higher than, statistically significant compared to 0.9? So that's a slightly more rigorous way of looking at the question. And I will come to that very quickly. And then if you do establish, if you're able to establish sustained differences in performance between private and public sector banks, the next thing to do is to give an explanation. Why is this happening? What are the reasons for differences in performance? And I think most laypersons would say, well, government is inherently inefficient, private sector is inherently more efficient, and so therefore there's nothing to explain. And as we will see, that's not a very satisfactory explanation, and we have to look a little more closely into the reasons for the difference in performance. So let's look at the performance, difference in performance between public sector banks and private sector banks. One measure is the non-performing assets. Let's look at the gross non-performing assets as a percentage of total assets. And very often, this is one of the parameters that is used to point out the difference between the two sectors. And so typically, people will look at a point in time. So let's say they will take 2018-19. Let's say, look at this number for public sector banks, 7.3. This is 1.3. It's a chasm of a difference. There's nothing to discuss here. They look at another year like this, 17-18, 8.9, 1.5. Again, the public sector banks fare miserably compared to the new private banks. But I would say, why don't you go a little further in time and say, look at 2009-10. What do we see here? 1.3 and 0.6. Not that much of a difference. The difference of 0.7, whereas here the difference is 5.6 percentage points. Take another year like 2008, 2009, 1.2 and 0.7. Not such a great difference. So if you look at it over a, in this period, let's say 2004, 2005, 6 to 2000, let's say 10, 11, period of about 6 years, the differences are not that stark. And secondly, if you look at the absolute number, 2% gross NPA or 1.2% gross NPA as a proportion of total assets is considered a very good number in banking. Internationally, the benchmark is something like 3%. So in all these years, if the public sector, if the public sector could stay below 3, then they are performing very well going by an international benchmark. So the point I'm trying to make is that comparisons in performance based on a snapshot taken at a particular point in time are hugely deceptive. Any meaningful comparison of performance must extend over a long period. And you must also explain why, at least in certain periods, the public sector banks are able to do well, and only in certain periods they're not doing well. It's not, if they were inherently worse, if inefficiency was entrenched in them, then at no point in time should the performance of the two sectors be remotely comparable. But we have seen that, yes, for fairly long periods, the performances are not that very different. The parameter on this one parameter, you don't see that kind of stark difference in performance. And the same argument one can make looking at return on assets. So again, people would look at some number like this. So 2019-20 negative return on assets. Private sector 0.51. But go back in time. So if you look at 2009-10, 0.97, 1.28. Look at 2008-9, 1.03 and 1.13. The difference in performance is only in the second decimal place. And let me also tell you that internationally, a return on assets of 1% is considered very good. It's considered well above average performance internationally. And you can see that public sector banks are close to 1%, not very far from 1% for a very long period. So this contention that there is something inherently rotten in public sector banks which prevents them from doing well compared to relative banks, I think the two tables that I've shown, which is only a very small slice of the overall comparison and performance, should at the very least sow some doubts in the minds of people about this hypothesis of superior performance of the private sector. So the very rigorous studies have been carried out, academic studies have been carried out. And unfortunately, the academic literature doesn't find expression in the public discourse. Most of the discussions in the public domain are based on the kinds of petty comparisons that I mentioned. Whereas there is a huge amount of literature, which I have cited here. I don't have to go through all these papers, but say this paper by Sarkar and Baumik showed that in the post-liberalization period, right up to 2010-11, there was a trend towards convergence in performance between the public and private sectors. Whatever difference was there prior to liberalization was actually getting narrowed right up to 2010-11. And this is also borne out by my own study by Das and Kumbhakar. These are all academic papers which I can share with people who are interested. And so all these academic studies show that the public sector showed a tendency to catch up with private sector right up to 2010-11. and the divergence in performance happens only thereafter. And therefore, it's necessary to ask why for a very long period post-liberalization, 1994 is when liberalization started, up to 2010-11, there was a convergence in performance, and why did the performance diverge thereafter? And the explanation that I submit to you is that the divergence in performance is because public sector banks took greater exposure to infrastructure and related sectors than the private banks did. As a matter of public policy, they were asked to boost lending to infrastructure and related sectors. And the entire Indian economic boom in 2004-08 was driven by private investment in infrastructure, and this private investment was funded by public sector banks. So what is the story that we are seeing? There is an unprecedented economic boom in India in 2004-2008, which was driven by private investment in infrastructure, which was funded by public sector banks. So if this kind of funding by public sector had not happened in this period, then the economic boom would not have been there. No public sector funding, no economic boom. You have to be very clear about that, because the private sector did not fund the private investment to the same extent. They were all taking exposure to retail sector. So the infrastructure-led economic boom in India was primarily the result of public sector banks taking huge exposure to these sectors. So in December 2014, 5 sectors, mining, iron and steel, textiles, infrastructure and aviation, accounted for 29% of all advances and 53% of stressed advances in public sector banks. Whereas these sectors and the private sector, in the private sector, they accounted for only 13% of advances. So 29% of all public sector bank advances were to these 5 sectors, 13% in the private sector, and they accounted for 53% of stressed advances and a much lower figure in the case of the private sector. More exposure to infrastructure related sectors, more non-performing assets, as simple as that. And therefore, the private and foreign banks chose to take a lower exposure to the sectors which are of national priority, and they were impacted to a lesser extent as a result. So, as I said, if the public sector lending had not happened, the economic boom would not have happened. And therefore, the correct way to look at the public sector financing of infrastructure, which led up to non-performing assets, that is it is a form of deferred deficit spending. Government does not have the funds to finance infrastructure through the budget. So it passes the burden onto the public sector. So instead of the infrastructure being financed by the government through its budget, the public sector banks financed it in 2004-08, ended up with non-performing assets and losses, and then the public sector banks had to be refinanced by the government. So this is a form of deferred deficit spending. The FRBM Act did not allow the government to incur deficits beyond a certain point. Government was very keen in those days to stick to the FRBM limit. So it pushed this kind of expenditure onto the books of banks, and it had to incur that same expenditure with a lag. It's as simple as that. So the next question that arises is, assuming that the government gave the mandate to public sector bank to lend to infrastructure in a big way, were they reckless in taking these exposures? After all, government can tell them to lend to infrastructure, but you could argue that public sector banks should manage that risk well, very well. Now, there are a number of points that I would make in this connection. The first is, the stressed asset exposure in infrastructure is not a public sector bank problem alone. In all the big projects where the public sector banks have taken a hit, the private sector banks and foreign banks are also involved. So if they were that good at risk management, then they should have stayed out of these particular projects. They didn't do that. What they did was to take a lower exposure than the public sector bank. So if they were so great at risk management, if they are so efficient, then they should have steered clear of these sectors. But they did not make that kind of judgment. So the second point I would make is that everything was going well in these infrastructure related sectors until the global financial crisis, which is an extraneous factor, happened in 2007, 2008. And as a result of the global financial crisis, the cash flows in the sectors to which the public sector banks were exposed, they were impacted negatively in a huge way. And therefore, the key sectors to which the public sector banks were exposed were impacted by factors extraneous to management. What were those factors? One of them I mentioned, global financial crisis. Adverse court judgments, as in the case of telecom licenses which are cancelled. Which manager can anticipate that this matter will go to the Supreme Court and the licenses to the borrowers will be cancelled? I mean, it's really too much to expect that kind of prescience on the part of any banker. Mining was impacted by court judgments. Steel was impacted by massive dumping by China. There was a general slowing down of the global economy due to the subprime crisis. So what I'm saying is that you cannot ascribe the non-performing asset problem which has arisen since 2010-11 to bad management in the public sector banks, because the overwhelming factors were extraneous to management, such as the factors that I mentioned. How could any management which has lent to a particular sector anticipate the kind of adverse court judgment that you have had? Who, even among the brightest of economists, anticipated the global financial crisis, which turned out to be the worst crisis in a century? So if the greatest economists in the US and elsewhere could not anticipate it, I think it's a little too much to have expected public sector bankers to have anticipated the same. And so this is not just my view. The economic survey of 2016-17, which was authored by Dr. Arvind Subramaniam, I quote from that survey: the vast bulk of the problem, the NPA problem, has been caused by unexpected changes in the economic environment, timetables that have gone wrong, exchange rates and growth rate assumptions going wrong. So this view is also the view affirmed by the economic survey, which is an official document. So I conclude based on this that the non-performing asset problem which we're seeing at public sector banks is not one of managerial incompetence or corruption, but it has arisen from public sector banks serving larger national objectives. So you tell them to fund infrastructure because that's a national priority. When things go wrong in those sectors because of adverse extraneous factors, you lay the blame at the doors of public sector bank management. This doesn't seem to be, to me, a very fair way of looking at things. Sorry. So, and this is not something that is new. It happens all the time. If you take all the key national priorities, demonetization, who bore the brunt of demonetization? Public sector bank. Jan Dhan Yojana, which is the extension of savings accounts to large numbers of people by way of financial inclusion. Who bore the brunt of that? Public sector banks. Agriculture loans, education loans, who bears the brunt? Public sector banks. So you ask public sector banks to serve various national priorities, and then when that is duly reflected in a higher level of non-performing assets, you lay the blame at the door of public sector banks. And the other thing is that for all these national objectives which they take up, you don't compensate them in any way. And the former RBI Governor Raghuram Rajan has made this point, that if you entrust public sector banks with particular mandates such as demonetization or Jan Dhan Yojana, then it's appropriate that you pay suitable fees to them to compensate for the work that they're doing. But this never happens. So you will saddle them with all kinds of national priorities, and then when that is reflected in the financial results, you point the finger at incompetence or corruption. This is the story which has been going on in recent years. There's a much broader point that I would make when you're comparing public sector and private sector bank performance, apart from the fact that the public sector banks has taken on certain national priorities. See, to a very large extent, the difference in performance reflects, in my mind, a failure of accounting, because the public sector bank generate a lot of what you call positive externalities which are not taken into account in financial measures. So, for instance, Jan Dhan Yojana or demonetization, or the way that for instance, the kind of welfare measures that they take up for employees, the sort of measures which you don't find in the private sector for employee welfare. Now, this generates positive externalities in the economy. It's a way in which large numbers of people are taken care of in relation to basic needs such as education and health and so on. So public sector banks take up these initiatives, but this is not reflected in the accounting measures. Similarly, the private sector banks generate a lot of negative externality, such as what? Inegalitarian pay. What is the ratio of the top pay to the lowest pay in the public sector? In general, it's in the range of 12:1 or 20:1 at the most. In the private sector, what do you think is the ratio of the CEO pay to the pay of the peon? I think it must be something like 3,000:1 if you include stock options and all. So private sector banks, like private sector entities in general, they contribute hugely to inequality in society. And economists recognize that inequality affects growth in various ways. It is what we call a negative, in the jargon of economics, it's a negative externality. It's a cost which a private company imposes on society. Similarly, when private banks indulge in sharp practices, I'm using a very mild expression, they cut corners and indulge in sharp practices, there is a cost to society. There's a lowering of the general ethic in society. That is also a negative externality. But all these positive contributions of the public sector and the negative contributions of the private sector are never reflected in the financial accounting measures. And therefore, the comparison of private and public performance based on pure financial measures is fundamentally flawed. First, I made the point that even in terms of financial measures, there is a trend towards convergence in performance. Now I'm making an even stronger point that the comparison is in any case conceptually flawed because you are not taking into account various positive and negative contributions from either side. Now, there is a further argument that some people make, which is that it's all very well to say that public sector banks need to be compensated for subserving national objectives, but the political economy is such that this is not going to happen. It's not happened in 50 years. It's not going to happen in the next 50 years. So the way public sector banks are functioning will never change. And therefore, privatization is inevitable. So politicians will always interfere with the commercial functioning of public sector banks. And therefore, public sector banks are doomed to underperform relative to private sector banks, and therefore privatization is inevitable. So I put it to you, should we accept this as inevitable, or should we get politicians to change? Are they not accountable to the people? Why should we accept political interference in commercial performance of public sector banks as a given? I put it to you. But anyway, this is the argument that many people make. So look, we cannot change politicians, and therefore we have to change the character of public sector banks. So much for the first argument, which is the efficiency argument. Now let me turn to the second argument which is made for privatization, which is that public sector banks make unending demands for capital of the government. So they will go on running up losses. The taxpayer has to keep funding these losses. And the short answer to that point is, if public sector banks make demands on taxpayer money, so do private banks. And this is because there is nothing private about banking. All banks, provided they are big, they are of a certain size, are subject to a safety net provided by the taxpayer or the government. So whenever any large bank fails, whether it's a public sector bank or a private sector bank, the government has to step in. And this I don't have to tell you because this is a story of the global financial crisis, where some of the biggest banks in the US and elsewhere failed, and they had to be bailed out by the government. So the biggest failure in UK was the Royal Bank of Scotland. And this is the biggest banking failure in the history of banking. The UK government had to step in to bail out Royal Bank of Scotland. And the cost that it incurred is greater than the cost in 2 years, what the UK government had to put into Royal Bank of Scotland is significantly greater than what the government of India has put into public sector banks since liberalization. So anybody who says that public sector banks are making demands on capital is not opening his or her eyes and looking at the amount of capital from the government which is going to save private sector banks. So I think the key question to ask is, if both public sector and private sector are going to make demands on the exchequer, who is going to make greater demands? And the numbers I'm going to present to you will come as a bit of a revelation. In the period 2007-8 to 2018-19, the government of India infused 3.15 trillion into public sector banks, which is roughly 1.1% of the average GDP in that period. If you look at the whole post-liberalization period, the cost would not exceed about 3% of GDP in India. 1994 onwards, if you take government or financial institutions in general, if you take the entire spectrum of financial institutions into which government has put money by way of recapitalization, it would not amount to more than 3% of GDP. Now let's compare with the cost of the exchequer in private banking system. The median cost of banking crisis, the IMF has done the study. They have looked at the median cost of banking crisis across 147 episodes in 115 economies in the period 1970 to 2001. What was the cost to the exchequer? It was 6.8% of GDP. And in emerging markets, the cost was 10% of GDP. And what is the cost in India? I repeat, 3% of GDP. So who is making what kind of demands on the exchequer? The Indian public sector banking, which has imposed a cost of no more than 3% of GDP, or the private sector, which has imposed these kinds of costs. The advanced economy is 6.8%, and in emerging markets, 10%. So in fact, there was a study carried out by the Basel Committee on Banking Supervision, and they found that the median cost of a banking crisis can come to 3% per annum. The cost in India is 3% over more than 20 years, since 1994. And this is the cost per annum. So I would say that India's public sector banking system has imposed the least burden on the exchequer compared to any set of, any set of banking systems worldwide. So the capital argument for privatization, lack of capital argument for privatization, I would say is even weaker than the efficiency argument. So I've dealt with the first question. How much time do we have? We are running out of time. So let me quickly go to the second and third points. So assume that we are going down the privatization route because the decision has been taken. The nitty-gritty, the details of privatization, how, what, and when are very important. So the first question is, if you're going to sell public sector banks, who are you going to sell it to? You have to be very clear about this. So yes, you can sell to Indian private banks, the banks that are doing very well, like say HDFC Bank. But the question is, do those banks have an appetite to buy the public sector banks? They have a large enough network of branches on their own, 4,000 branches, 5,000 branches. Why would they want to invest in public sector banks for the sake of the branch network when they have got a large enough network on their own, whether it's ICICI Bank or HDFC Bank? The rest of the private sector banks, there are very few who have the capacity to absorb public sector banks. The Indian private sector banks are unlikely to be big takers. What about Indian corporates? As you know, corporates coming into banking is turned out to be hugely controversial. The RBI final policy on that is awaited. The working paper had come out. But you can be pretty sure it's going to be politically contentious. And I doubt that the RBI is going to open the gates to corporates in a big way, at least so far as acquisition of public sector banks is concerned. What about selling to foreign banks? Well, I'm afraid the leading foreign bankers are actually retrenching from India. And the RBI has laid down such onerous norms for foreign banks to set up subsidiaries here that they don't see any great fun in coming into the Indian market. So you may want to sell to them, but again, there are very few takers among the foreign banks. So the model which is suggested is the selling to the foreign institutional investors, which is the Axis Bank model, where the government allows its equity stake to drop below 50% so that it ceases to be public sector, and the management becomes accountable to institutional shareholders. So this is what the PJ Nayak committee had advocated. Why don't you adopt the Axis Bank model for privatizing public sector banks? I think this is a move that is fraught with considerable risk because India doesn't have a culture of professional managers answerable to large institutional shareholders. If you look at the Indian private sector, it is promoter driven. There are very few companies, successful companies, which are run by managers. You can name them, you can count on your fingers. Say Larsen and Toubro would be one of them. ITC is another company. Again, has some foreign ownership. Maybe a few banks. You can count, like ICICI Bank. Mostly in India, companies are promoter driven. In the private sector, it is the industrial house which is the promoter. In the public sector, it is the government which is the promoter. The Anglo-Saxon model of firms run by professional managers and accountable to large institutional shareholders, this is a model which has to still to evolve in India. And leaping into it, so far as public sector banks are concerned, is fraught with risk, in my opinion. So even if you take Axis Bank, it was not handed over to institutional shareholders overnight. It started off as a government entity, this UTI Bank, and LIC and other institutions continue to have significant stake. They still have. And so you have, government stakeholders who act as active monitors, and the monitoring is not done by the financial institution. So the Axis Bank model does not give us reason to believe that overnight you can hand over the public sector banks to dispersed foreign institutional investors. The option which seems to me most viable is the private equity option, because private equity inherently, the monitoring is of high quality. They take a lot of interest in the day-to-day running of the firm. But again, so far as private equity is concerned, foreign ownership would be an issue because there are not a large number of private equity firms with the necessary capital to buy out the public sector banks which are going to be privatized. So when you think through the details, you say privatized public sector bank, but the moment I put this question to people, who is going to be the buyer, you find that there are no easy answers. The second problem in privatization of public sector banks is the issue of valuation. I will not go into it very deeply, other than to say that valuation has proved contentious even in the case of an entity like Air India, where everybody has decided that you want to sell it. Since 2018, the sale has been going on. You would consider it a very obvious case for privatization, but it's not happening because valuation in public sector banks is going to be very difficult because they are sitting on large tracts of land. The assets, they have large number of bad loans, so it's difficult to estimate the cash flow coming out of these banks. Valuation is going to be very tricky. And if you sell public sector banks cheaply, you are going to instantly have cries of scam all over the country. They will say, you sold it very cheaply and this is a scam. And the government will not be able to proceed further. So whom to sell is a problem. When do you sell it? Most of the public sector banks are trading below book value. Many are at 0.5 times their book value today. So do we sell now or should we wait to improve the valuation? If the government sells now, it will not meet its objective of maximizing revenues. If it's willing to put in some effort to improve the valuation, if it sells it 2-3 years down the road, then there is a chance that it will get better realization and better revenue. So timing is also an important issue. I think there's a fairly large number of people who are agreed that the present time, which is you have a basic NPA problem and then a COVID problem, this is not a very good time for undertaking any large-scale privatization of public sector banks. And there is also the question of what to sell. And you can see different voices coming from the government. If you sell the weakest banks, you're not going to realize large revenues. If you sell the strongest banks, you will realize large revenues. But why would you want to sell a bank which is doing well, which is performing well? There's a contradiction there. You want to sell because you want to improve efficiency. Then why would you sell the most efficient public sector banks? You can see that there's a contradiction there. And the other point, which I think the president mentioned, is taking care of employee interests. So the first thing that happens after any privatization is that employees are laid off. And here you have to safeguard the jobs of employees, you have to safeguard pension and other benefits. And so the unions will fiercely oppose these moves. And there's every possibility that the government will get into an ugly confrontation with bank union of the sort it is having with farmers at the moment. And therefore, my own sense is that the execution part of privatization is not going to be easy because getting the details right is a huge challenge. So having discussed the theoretical case for privatization and having given you an idea of the difficulties in execution, let me come to some broad conclusions. These are only tentative conclusions which we can debate in the next few minutes. In my view, there is no clear case for dismantling the public sector, but there could be scope for reduction in the number of public sector banks. So if you want to get rid of a few weak public sector banks so that you can strengthen the rest of the system, I think that is a fair objective. So if the government is to sell the idea of privatization to unions, it must pitch privatization as a means of strengthening public sector banks and not as a means of dismantling the public sector. That is not going to sell at all. So tell them, look, we can't manage so many public sector banks and do a good job of it. Let us focus on a few stronger banks and make them really strong. And let us let go of 2, 3, 4 of the weak banks. I think that is an argument which unions and other stakeholders may be willing to buy, although I'm not very sure. So you say that the weaker banks are to be sold so that the stronger ones can be better protected. And the proceeds of privatization will be used to bolster capital and the remaining public sector bank. We will sell something and get rid of the weak banks so that we can strengthen the rest of the public sector. This is an argument which can gain acceptance. And there is merit in boosting capital to public sector banks because it will immediately improve the valuation and it will also boost credit growth at public sector banks. And therefore, the government should present privatization of public sector banks as a means of creating a stronger financial system with the collaborative efforts of all the stakeholders, government, employees, private capital, institutional shareholder, customers. So let this become a grand national objective with a shared objective where we want a core public sector which is very strong, and for that reason we will let go of the weaker part of the public sector. But the warning which I would give is that if you mismanage the privatization process, then it's going to pose a very serious risk to financial stability. If you sell the public sector bank to the wrong buyer, you are going to end up with more yes banks, which you will probably throw into the laps of the hapless State Bank of India for rehabilitation. So that same story is going to be repeated. So you cannot afford to mismanage the privatization process. So my suggestion has been that you should view bank privatization as an experiment. Try it out with a couple of public sector banks, watch the outcomes for 3 or 4 years, learn some lessons about how to go about doing it, and in the meantime, commit to maintaining the share of public sector banks at say 45 to 50%. And then if this objective is achieved, and if you can do a good job of privatizing 2 or 3 public sector banks, then the positive outcome that we can look forward to is a stronger banking system in which we have strong private sector banks and also strong public sector banks. A win-win outcome for the private sector and the public sector. Thank you very much.
Thank you, Professor. That is a lovely keynote, scintillating observation, and a very erudite keynote that you have actually made today, and a very fresh perspective on all that we have heard. There will be some questions. Will you be able to spare maybe 10 more minutes, Professor?
Yeah, sure, no
Yeah,
problem.
because there could be some questions from the audience as well as there could be some questions from the voice.
Sure.
Professor, one question. I think it is the privatization started in 1960. I mean, happened in 1969. So that was not the study time for all of us then. But do you think what was the rationale of privatization in 1969, Professor?
You mean nationalization?
Nationalization.
Will you repeat again? It was actually, I didn't hear. Sorry.
Yeah,
No, I think they're asking-
it was nationalization, not privatization, 69. That's what Professor was asking. Yeah.
I was Jobon. That's okay, but let Professor answer the question.
No. What happened in 1969 was nationalization, not privatization.
Yeah, so I was asking, the banks were nationalized during 1969. So
Yeah.
what could have been the motive of the government to nationalize at that point of time that they are now thinking of a rationale to privatize now? That was the question, sir.
Yeah, so the rationale in 1969 was very clear, but it is forgotten. There were massive failures in the private sector in the years post-independence.
Yeah.
Colossal failures of private banks.
Yes.
So that was one reason.
Yep.
And the other reason was, of course, increasing the reach of the banking system. Most of the banking was confined to the urban elite.
Right.
And the entire geographical reach which has happened, where banking has extended to vast sections of the population, both on the liability side and the asset side, both in terms of deposits and in terms of loans, this is strictly an outcome of bank nationalization. So it was the colossal failure of the private sector prior to 1969, which provided the basis for bank nationalization, and that is not disputed. I think even the arguments for privatization today, even many of those who are arguing for that, many of them don't say that nationalization at that time was bad. All they are saying is that it has run its course and now it's time to reprivatize.
Right. Professor, you have actually very correctly said that, if it is not managed well, this could boomerang. That is what finally the understanding is. Looking at some of the challenges that the government has done in its first phase, like demonetizing and things like that now, what do you think could happen? I mean, if there is a prognosis, what could that be?
Well, I think the government is committed to privatization.
Okay.
There's no going back on that.
Okay.
But you see, the speed
Yeah.
is the question. So they talk about privatizing 2 banks now, but going by media reports, I think the number of candidates for privatization is a little larger. 5 or 6 banks have been earmarked for privatization.
Okay.
And so the question is over what time frame and at what speed.
Yeah.
And this is not something which you can be done, as I said, with a wave of your hand. You say off with public sector banks and they disappear. It's not going to happen.
That's right.
So the execution is very crucial. And in the very nature of things, you have to proceed cautiously and make sure that governance doesn't become a casualty when you transfer the ownership from public to private sector. If that happens, and let's say, one of the candidates, let's say, is Bank of India. If you sell Bank of India to a private party and if Bank of India fails,
Yes.
all hell will break loose.
Understand.
Politically, economically. It
Yes.
will be bad for the banking system. The political fallout will be huge. And therefore, I'm saying that you cannot afford to get this wrong.
That's it. You can't afford to get this wrong. Okay, right. So there's a question from Mr. Balkrishna, who is a vice president, also executive director in Geojit Financial Services. He is asking, what is your view on Narasimham Committee report and 4-tier banking? Forbes report 2019 stated that HDFC Bank is number 1 and the SBS position is number 11. Do you think the parameters considered are extravagant?
Yeah, so I think there's no question that HDFC Bank is ahead of SBI in terms of parameters.
Yes.
But you have to ask, what are the functions that HDFC is performing and what are the functions which SBI is performing?
Yep.
So you cannot saddle SBI with 20 functions which HDFC Bank is not performing and then compare the performance.
Yes.
That is a simple point.
Okay.
But even then, you see, since somebody is mentioning HDFC Bank, let me share with you. I once had occasion to have a conversation with one of the top bankers at HDFC Bank. He subsequently went as chief executive of a foreign bank. He had come from a foreign bank into HDFC Bank and then became CEO.
Yes.
So we were talking about banking sector in general, and then I asked him,
Yeah.
do you think that State Bank of India at some point should be privatized?
Yeah.
And he told me with some conviction and passion, it can never happen. So I asked him, how do you say that? Why do you say that? He said, and this is a private banker at the HDFC Bank telling me, he said, SBI is a national treasure. So anybody comparing HDFC Bank and SBI should remember this particular remark.
Yeah, so it's a national treasure. Okay,
Yes.
that's right. Balagopal Chandrasekhar, who is actually also the independent director at Federal Bank, has this question for you, Professor.
Well,
India's
please
credit flow as a proportion of GDP is very low, approximate 50% versus double that of China, and even higher figures for OECD countries. How can this be taken up? Will PSBs not be needed for that?
Yeah, so at the outset, Mr. Balagopal, please convey my regards to Shyam Srinivasan, with whom I have had more than, with whom I have a very pleasant relationship. Yes, to answer your question, again, this is one argument which is made. So 50% of GDP is a bit of an aberration. It had gone up to about 59, 60. It has come down the last 2-3 years because of the NPA problem in the banking sector. You see, this argument is made, comparison with China, developed economies and all that. And again, from an academic point of view, this is not a correct comparison to make, because you must look at banking credit as a proportion. You must look at,
please mute. Yeah, please go ahead, Professor.
you must look at the credit to GDP ratio in relation to the stage of development or per capita income of the country. So you cannot compare credit to GDP of a low income country like India with that of China, which is a middle income country, or that of the US.
Yes.
So if you correct for per capita income and then compare credit penetration in India, we don't come out badly at all in comparison with the range of other economies. So this is the difference between the academic way of looking at things and the media way of looking at things. So they just take some numbers,
I get
media. So the media way of looking at non-performing assets and the media way of looking at credit penetration. These are all, misconceptions which are deeply entrenched in public discourse.
Right.
And unfortunately, I think academics don't come out in large enough numbers to
Yes.
refute all this, because
Understood.
they're too immersed in their academics to spare time for all this.
Understand. There is a question from your friend and former colleague A. Joseph. He is asking, performance indicators, public sector banks, how is it a true representation?
Yeah, so as I've argued, it is not a true representation because it doesn't adjust for positive and negative externality.
Okay.
It doesn't. And it also does not correct for the objectives which they are asked to subserve.
Yep.
The true comparison will be when you tell the public sector bank, you choose your financial objectives and pursue them, and
Yes.
I am not going to give you any objective.
Yeah.
But that has not happened at all. So all the time, it's a mix of commercial and non-commercial objectives which public sector banks have to balance.
Yes.
And you compare with a set of players who have only commercial objectives to pursue. So this comparison. So I think you have to ask yourself, I mean, I couldn't cover all the points in my presentation. The private sector banks, they focus mostly on what is called the mass affluent, not the upper crust of the population, but the next tier, which is fairly large, what they call mass affluent. That is their captive audience. Whereas for public sector bank, it is a mass public. And
Yes.
therefore, the question that needs to be asked is, public sector banks vacate that space, who is going to take care of the banking needs of large numbers of ordinary people? If you go into the interior, large numbers of ordinary people will not be very comfortable going into a private bank and dealing with those kinds of well-heeled people, whereas they have a certain natural rapport with public sector bank employees. And these are all relationships which have been established. If you look at your own town, your own city, you will find that there is a certain relationship which has been established over many decades.
Yeah.
And it is not very easy to recreate this relationship in a private sector setting.
Yes.
So whether private sector banks would want to continue to cater to the same clientele, the same mass base, is a big question mark.
Understand.
And therefore, you have to ask yourself, have we crossed the stage when public sector, where banking is required to serve broader objectives or not? Are you sure that you've reached that point? I don't think we've reached that point. There is still a certain social orientation required in banking. We have not crossed the thing when it can become a point where it can become completely commercial.
Right. We have this question from Eldo Isaac. He's asking this question. Do you see S-Bank-like episodes in the Indian bank sector in the near future?
Well, I hope not. but I gave you the figure for a range of 110 economies over about 30 years.
Yeah.
And you take all the private sector banking systems, starting from the US to anywhere you want to go, to Norway, Sweden, Scandinavian countries. You can take all the private banking sectors.
Yes.
Once in 15, 20 years, these fellows, at least once in 15, 20 years, they will have a serious banking crisis.
Yes.
So I would say that the private sector banking system is inherently prone to crisis.
Yeah.
Given the focus of top management on profit and bonus and stock options and so on, the incentives are such that failures and crises are inevitable in private sector banking system.
Yes. Okay.
And therefore, I would not see Yes Bank as an aberration. I mean, if Lehman Brothers, which is one of the biggest names in world banking, international banking, could collapse,
yes.
If Royal Bank of Scotland could collapse,
yes.
then we should not be overly surprised that you have Yes Bank failure or ILNFS or that kind of phenomenon in India. They should not come as a surprise. If it doesn't happen, it's a surprise.
Well said, Professor. This question is from Sauvik Roy, who is the executive assistant to your good friend Shyam Srinivasan. Okay. Currently, FDI is permitted to 74% in the banking sector. FDI equity inflow is highest, 16% in the services sector. Do you see this going north post the privatization, or are we looking at large-scale exodus of FDI?
Yeah, so I think this speaks to the larger question of foreign ownership in banking.
Yes.
And the RBI's policy is very clear.
Yes.
That if foreign banks want to come into India in a big way, they must set up their own 100% subsidiaries, subject to various norms of governance, such as having 50% of the board as independent directors, locals, and all that.
Yeah.
And therefore, unless RBI makes a 180-degree change in its policy stance, which is unlikely, because RBI doesn't make those kinds of dramatic changes in policy, it is highly unlikely that FDI.
Yes.
FDI in banking can go up. FII, of course, we are open to FII on a presence in banking.
Yes.
74%. That can, of course, that is possible.
Right.
But foreign direct investment with foreign banks coming in, given the present RBI framework for foreign bank ownership, doesn't seem likely.
Okay. Sir, the billionaire Bill Gates has once said that banking is needed, banks are not. What is your comment?
Yeah, I think that is true. You have non-bank finance companies, you have fintech. So there are a number of banking services,
yes,
which can be provided by non-banking entities,
yes,
including big tech. So Facebook or WhatsApp and all can provide particular banking services. But I think the question that has not been answered is the full scope of banking services, what we call universal banking.
Yep.
Can that be provided by non-banking entities in a comparable sort of way? So they can provide payments, I understand that. So they can provide certain kinds of loans to certain kinds of clients.
Yes.
But from the liability side to the asset side, the entire spectrum which a universal bank covers, I have not seen a non-bank entity match that so far.
Okay.
In future, if they can match that, subject to banking regulation, well, nobody can sort of realistically oppose that kind of thing. But contrary to what people have been saying, the banks have not vacated their space in a very big way, in the kind of way it was anticipated. They said fintech will come and knock out all the brick and mortar banks and all that. Nothing of that kind has happened.
Sir, when you said the fintech, I have this question. There's a new, in the fintech arena, particularly startup fintech arena, a new term has come up called open banking. And we have some of these institutions here, a company called Open.bank, what is the scope of these institutions as a continuation to your question that, the question that you were answering?
Yeah. So, yeah, open banking is, the information on customers which banks have.
Yes.
Regulators are moving towards having that information provided to others
Yes.
who can use that information to provide alternative services.
Yes.
So you can take the customer data
Yep.
and a competitor to a bank can come and provide that. So, well, first of all, there's a question of privacy and whether this is all subject to customer agreeing to the data being shared. And not all customers will be comfortable with data being shared to all and sundry.
That is right.
Banking data, that is one thing. And the second thing is, you can say that those fellows can come in and provide a cheaper service such as low cost loan and all that. But the general experience is that most people would not entrust their savings to some entity which is not there on the net.
Right.
You see, by and large, the psychology is if I want to put my money in the bank, I want to see some building.
Yeah.
I want to see a safe deposit somewhere,
Yes.
a vault somewhere. So you see, the present psychology, I mean, I don't know what is going to happen 10 or 20 years from now.
Yeah.
But contrary to all kinds of forecasts which were made 10 years ago,
Yeah.
brick and mortar banks have not disappeared.
Yes.
The same brick and mortar banks are relying less on brick and mortar and more on online
technology. Yes.
Yeah, they are using a combination of, as they say, clicks and bricks
Yes.
to offer banking services. But the other guy coming and dislodging banks with brick and mortar, that we are not seeing in any credible way so far.
Professor, for more than an hour, your stamina is absolutely phenomenal. You have been at the same wavelength and same energy that you have started with. Really wonderful. And your performance had been, your keynote performance had been very erudite and it was scintillating one. And also, you have actually, you really bailed PSBs out. And with your argument as well as with the data that you have actually supported that with. I think we should also appreciate PSPs for the stellar performance that they've had against the norms, etc., that is being kept by Basel about 3% per annum, etc. Thank you so very much. It was such a pleasure having you here. We were very worried, actually. Professor, it was 4 o'clock onwards. It was raining cat and dogs. It rains, and it was howling. The wind was howling. We thought, my goodness, Professor is going to be disappointed if I'm going to show you less number of audience. But we have had fairly good audience, and you really engaged them well. It was such an very high level of information that you have received from you. Thank you so very much. I'm going to now request our Honorary Secretary Jomohan K. George to wind up and propose the vote of thanks. And thank you so very much. And I'll get back to you later also, sir. Thank you very much. Jomohan, all yours.
Thank you very much.
Thank you, sir. Good evening to all of you. I think President Madhav got disconnected in between, and in absentia, thank him for organizing this program to start with. And Program Committee Chair S.R. Nair, as usual, seamlessly coordinated the session with the introduction, then picking up the right questions, and then adding to Professor's viewpoints and the tech points, which is typical of him to come out say that, okay, banking would continue and banks would disappear, the new perspective to all that. Before I move on to formally thank today's very learned speaker, I have to make an announcement. Our Women Managers Forum is very active, headed by Madam Shalini Varia, who's Executive Director at the Federal Bank. Again, your friend's close associate, Professor. The Women Managers Forum is coming up with the session on 8th of April. The Vice Chancellor of Delhi University, Skill and Entrepreneur University, Professor Neharia Vora, is taking a session on women directors, how to get past the tokenism. We know that the women directors, a mandatory requirement by most of the time, they just complied with for the sake of keeping the regulator happy and not really coming on board and making the contribution that the might and I would say that the capabilities that the women directors can really bring into the boardroom. So Women Managers Forum is doing a wonderful job. We had so many sessions, very, very innovative ideas have been coming forth. So I think that is one important program which is coming up. So I request the members to stay glued to the upcoming programs. Now my duty of proposing vote of thanks, as SR rightly said, 1 hour of a very, very well-researched presentation on the case for privatization or the case for not privatizing. And the speaker, and he stood like a very strong defender, I would say a great advocate of public sector banking in the country, giving all the relevant statistics, the global statistics, how we pitch in with that, and of course the the performance vis-a-vis the private sector banks. So the key point which was driving was that they have been playing a very important role in the building of the nation, and the term which he used is very rarely striking, was a deferred deficit spending. And because that the government cannot keep on funding, so as the public sector banks, so it's a vicious circle which happens, and then the capital gets eroded, the NPA is on the rise, and then recapitalization happens, and so on. So that is a very good case, and concluded saying that okay, let there be some part of it, but then the Indian economy needs a very strong network of public sector banking. The point is so very well taken, and the observation that the political economy wouldn't let banks perform beyond a certain amount of flexibility was also striking, and very new terms like median cost of banking errors and all those things was really striking. So not really unexpected of a person like Professor T.T. Ramohan, so very well researched topic and answered all the questions in the right perspective. So on behalf of all of us here, the KMA Managing Committee, and all the audience here, and we are really nice to see Mr. Sri Balagopal, former IAS officer, and who has asked a question and stayed relevant throughout the session. Nice to have you on board. I think we had Colonel Markar also joining from Vizag and all that. So we had a very good cross-section of our audience today, audience profile. After every meeting, we're happy that's getting enhanced and expanded. So the credit goes to excellent lineup of speakers. Thanks, Mr. K. Joseph, also for connecting us with Professor Ramohan. So a big thank you, sir, for being with us this evening. And we have a very specially made a memento for you, which would now be displayed on screen and which would be sent to you by post. So Pajit.
Professor, this is real time. You have been shot real time and put in here. This is a physical memento which will reach you.
Yeah, that is so specially curated for you, and this has become a signature memento for from KMA. And one of the speakers who came here physically when we gave it, he said, "This is proof that to show my wife that I was actually in Cochin." So virtually, at least, if you need to prove some proof, yes, this is for you from especially from KMA. So once again, a big thank you for that very, very, I would say, the insightful session on why privatize or why not privatize, whichever way we look at it. So, and we would also like to thank our sponsors who have been continuing to support us, Medivision and the HEAL and SERA, all for all their continued support for all the KMA programs. So stay glued to the upcoming programs, particularly the one which is on 8th April, which is by the Women Managers Forum. A big thank you to SRF once again for the excellent coordination, and to the secretariat there, the Mr. Jojo, Prajit, Padma, all of them, for making the technology happen and the event going, putting all the elements together. So have a wonderful evening. Stay safe, stay focused. Thank you very much.